Howdy, Jacob here. Today we're looking at Church and Dwight in the household products industry. 24.5 billion market cap on 26.4 billion enterprise value. Very large company. They sell its consumer products through supermarkets, mass merchandisers, wholesale clubs, etc. Company is founded in 1846 in New Jersey. They've been around for a minute. I don't know if I've heard of them, but very solid, very good market cap, very good return on invested capital. A little bit frothy of a price at this point. We'll see whether the growth substantiates that or not. But operating margin in the high teens, 18-19% is awesome. Gross margin low 40%. Return on invested capital low teens, pretty solid. Growth of the company, no declining revenue years of the last 10 years, which is amazing. They've been averaging about 5 to 6%, also very positive. Balance sheet has 345 million cash on hand, 204 million short-term debt, 2.2 billion long-term debt. Looks like they made a pretty large acquisition in 2017, funded it through long-term debt, and then have been paying it off a little bit, but another large net acquisition in 2022. And we do see that 547 issued some debt for it. 1.2 billion issued some debt for it. So their use of cash is going to be the dividend pays out $269 million, is about 1% yield. In relation to their free cash flow, you're looking at about 30-35%. Not terribly concerned about that. Acquisitions is a very heavy amount of their free cash flow. Buying back shares, a good amount, and then paying down debt. So my assumptions are going to be based on them making net acquisitions that are affordable to them, not going into debt for. And so for me, with the amount of debt they have on hand, about $2 billion, that is about 3 years, maybe even less than 3 years of their free cash flow. So we're definitely not concerned about the debt. And if their free cash flow grows as much as it has, as long as they, pay down 5%, 10%, refinance the rest, that ratio is going to go down even less. Because if you double your free cash flow, your debt stays the same. It's now 1.5 years of free cash flow to pay off your debt. And so they will have to refinance very likely, but I don't think their debt is a concern. But again, I don't like companies going into too much debt. 3 years is usually where I like to keep it, 3 years and lower. And so right now they're really tickling it. I'm going to assume that, maybe they don't pay down the debt, but they don't go into any more debt. So speaking of assumptions, let's start making ours. On the revenue growth side, I think 5% seems pretty reasonable to me. They have a history of being a very good company, so I'm going to give them a 17p in price free cash flow. This is more of an art. That is more of the artwork of investing. Here, I think I'm pretty comfortable giving them a 15 and 16% margin. Share repurchases, 1% would be about 240 million, but they haven't really bought back much the last couple of years. Let's just say they keep that flat. Dividend, like I said, under 40%, nothing crazy there. It's been around for a while, so I can probably increase that a little bit more. What have they done historically? Actually slowed down quite a bit over here. So let's just give them the growth of their revenue to keep the margins or keep the payout relatively the same throughout the 7 years. And this is saying a majority of their money is going towards reinvesting, acquisitions to get this type of return, maybe even 6% to get an extra little bit through acquisitions, since their payout on the share repurchases is 5 less than 5 to 10%, dividends 30 to 40%. We have about 60% of free cash flow capital allocated to acquisitions and reinvestment. And so I feel pretty good about that 6%. These type of margins look good, but it still needs to fall 59% given these assumptions. So for me right now, I think the company's fantastic, but it's just not at a price point that makes it look obviously cheap to me. So I will be researching other companies in the meantime, and I hope you enjoy the video and have a great rest of your day. Thank you.